Hi everyone, today is going to be one of the most lively sessions. In true sense, lively in terms of the participants, the number of participants, and this is going to be a session where there are a lot of youngsters who are representing you, the youth, and going to talk on your behalf. There might be people with very basic understanding. There might be people who have read something and understood more. Based on their thoughts, there is going to be a discussion here. It's going to be useful to all. Clearly, you will see representation of you, the youth. Let's go to the session. Moving forward.
Yes, sir. So starting off, I've come across a lot of content where people are asking youngsters to invest 500 rupees a month or 1000 rupees a month. I genuinely don't believe it's going to make that much of an impact in your future savings with just 500 and 1000. Might as well go out and make memories and later on invest. So, what are your thoughts on that?
So, if they say this 500 to somebody who's 40 years old, this may not necessarily make a big difference because he has another 15 years left or 20 years left, not more than that. Say 15 years, 55. So, that number 15, which is the number of years left, and the number which you have with you, which is, if you're about to start your earning now, it's another 25 to 30 years away, at least 25. You will work at least till, 50, maybe it will be till 55. So the number of years left makes this 500 very big. What I mean by that, 1,000 rupee SIP. Let me even put to 500, the number which you said. A 500 rupee investment made monthly for 30 years can grow to somewhere around 1.3 to 1.4 crores, right? So approximately 30 years, okay? In a year, how much you invest? 500 per month. 6,000 rupees. 6,000 into 30. How much is it? 1.8 lakhs. 1.8 lakhs becomes almost 1.4 crores. Is it small or big? Huge.
Actually, big, but when you adjust it with the inflation.
Correct. I understand. I understand what you are coming, where you are coming from. 1.4 crore after 30 years might be a small amount. Is it big in front of your investment of 500?
Yeah.
That's what I meant. Did you even imagine a 500 rupee investment will grow to so much? That is what I meant. I'm not really talking about the value of 1.4 crore. 1.4 crore may have the value of 30 lakh rupees today, something like that. 25 30 lakhs, but I'm only talking about inflation adjusted 25 30 lakhs or 500 rupees monthly for 30 years becoming 1.4 crores. That's big. So this amount, even if you wait for 5 years or 10 years and then invest, you may have to invest multiples of this to achieve the same 1.4.
Hi, sir. So my question deals with more personal finance. A lot of people older than me tell me not to get into credit cards because it's a very hard to escape form of debt and it chases you and the interest rates. But I also need to build a credit score, which you can't do unless you have some form of loan. And a credit card is a good way. So what are your thoughts on this? Should I or should I not get a credit card?
Okay. First of all, credit card is not the only source to build a credit whole score, right? And in a way, looking at the way the youngsters spend after the e-commerce days, credit card should be even more discouraged is what I would say. Maybe you should not buy a credit card until you are 30, 35. The reason is, whatever said, the value of savings or the seriousness of savings will be much lesser than it is when you are at 25. And at that age, if you build a huge debt and if you are not even able to pay or only able to pay the minimum amount, right? The minimum amount is, going to be very insignificant. The minimum amount payment in a credit card may keep your debt the same. It doesn't reduce it at all. The minimum requisite amount I'm talking about. That would mean your debt will remain as it is and only grow, right? Why I talk about e-commerce? Earlier, only if you went into a retailer, okay, or a garment shop, that's when you are tempted to buy. Today, your mobile notification itself will push you to buy, right? Credit card was discouraged for the very purpose that it increases your spend, which means you do unnecessary purchases and you give lot of importance to your wants than needs, right? Your wants goes unlimited, you buy and splurge and create a huge debt. And today, the reason for you creating a debt can be higher with e-commerce or not. So, credit card is something which has to be discouraged. If you ask me, today's income levels, even for a beginner, is decent, very decent as compared to what was there, whatever may be inflation. Even inflation adjusted, you have a very high beginning salary today. If this salary is not enough to take care of your expenses, then you will always find a gap and your income might always be lesser than your expenses. So you should start getting into the habit of keeping your expenses within your income, and not only expenses, income has to take care of expenses plus some kind of investment. For that, credit card might be a big spoiler. And you may buy a car some point of time. You may buy a house. You may probably take a personal loan, but unless it is really required, you shouldn't. But at least you will have this car loan, and at least most of them, very rarely people, though we advocate that you should create some savings and use your savings to buy a car, most of them practically tend to take it through a loan. These will take care of your credit history. For that matter, I personally did not have a credit card until about 6, 7, not 6, 7, about 8, 9 years back. And even then, my credit rating was among the highest because I had my housing loan. Okay. So that way, credit card, more than you, even the risk of it spoiling your credit score is high because of your overspending. And 1 month you miss your payment and it is gone. Right. So that can become a spoiler than even helping to build your credit score.
So, but I've also heard this other strategy where they say just use your credit card like it's a debit card, only swiping money that you already have. So, what do you think about that?
That is true. If you are able to do that, nothing like it, because you get a maximum of 45 days of credit period. If you are able to use that credit period, and as you said, the best way to say, use it like a debit card. You may think that it is going from your savings account bank, the money which you have earned. Don't think that somebody is giving you extra money. Credit card, usually the feeling is that somebody is giving you that extra money to spend. No, it is going from your pocket. If you had money in your pocket, will you buy this? Very often, if you take 10 cases of a credit card purchases, at least 6 to 7 will be purchases which he would not have done if it was not his credit card. And if it was his money, even if it was Google Pay. For that matter, psychologically, if you see, even your UPI payments have become like semi-credit cards. Like if you have 1,000 rupees in your pocket and go to buy a shirt, you probably will not exceed that. Had you not have a credit card, had you not had a GPay, right? Because though you have your account balance might have a higher amount, you have only this cash today, and this shop doesn't accept any. Or you imagine this was some 10 years back. If this was the money, only 1,000 rupees was available, you would have completely done only with that. You would not have exceeded that. But credit card or the GPay encourages you to completely clear off your bank balance because the entire money can be spent through the GPay or UPI. Credit card is even more bad. You feel somebody else is giving the money because you are anyhow bound to repay it. So as he said, imagine it is a debit card, not even debit card for that matter, as cash. Even debit card for that matter, you can exhaust it fully. Less than a debit card. Imagine the cash which you have. And this is a need, not a want. And if you did not have the money in your pocket, if you would not buy, don't buy it even if you have a credit card. That's how you should follow. So very clear. If this is not mandatory, necessary, and this will increase your debt burden just to satisfy your today's desire to have it, then you better don't do it.
So this question, even though it's personal, I'm pretty sure there are guys who would find this useful. So I personally invest a lot in SIPs and it's been going well for 2 years. Now the thing is, I've never checked it. I'm like, okay, I'll invest and I'll forget that it do whatever it can do. How often should I check? Is it important that I take the effort to check whether these funds are performing well? If it is that important, and how often should I do it?
See, the idea of you checking yourself is something which I will not advise. Why? Unless you are going to be in the same profession. If you are into the profession of managing investments or wealth management, I can understand, you have knowledge. This is your bread and butter business. Using that knowledge, you are managing this. If it is not the case, you should not be managing it. It should be managed by somebody who has a glance of it at least once in a quarter and goes very deep at least once in 6 months to find out whether that fund continues to be good in the category, whether it is consistent in performance. That's very important. See, if you are in a even slightly below average fund over a 10-year period, it may give you 11-12%. Okay, is 11-12% bad? Not bad compared to FD. It's only compared to that. But the comparison should not be with an FD there. It should be in comparison to that particular category. In comparison to that category, if it is consistently underperforming, then that call has to be taken. So a level of a review to that extent of in-depth required is once in 6 months. Okay, and it should not be done by you. I'll tell you why. You may buy online after do an online comparison of these schemes. So several data are available. And today, when you also want to do a review, you may do a review based on what information is available online. Online, on the face of it, there is so much of hidden information which is not seen to you. Like there could be a change in fund manager. There could have been couple of calls which have gone wrong. And when you do that, mind you, the information which you are seeing if you are on 31st of December, the information which you are seeing is 30th November information. It is 29 days old already. Okay, that information still might be backdated. And even that backdated information, so much is not available there. Okay, so whether you have bought a stock, okay, and that stock has fallen. I mean, the fund manager I'm talking about, in that portfolio, there is a stock which has fallen, and the fund manager again bought it at a lower price and has averaged it smartly so that the recovery could be faster. All this information is not known to you, right? So there is so much of information which is so vital, which is not available to your naked eyes or not available on the face of it. So whether you should spend so much time like a professional, then your whatever profession you are into, you will not do justice to that, which means you will ruin your career for the sake of taking care of your investment. That you should never do.
So one more question is that we've seen a lot of market falls and a lot of bull runs and all of that. So during a market fall, I mean, a normal person, he might think it's a short-term volatility, or he might think it's a major correction. There are two possibilities. What are certain indicators that can let us know which is which? Like, is it a short-term volatility, or is it a depression or something?
See, both the cases should not shake you much, because most of the time youngsters are investing through the monthly investment route, which is SIP, right? So if it is temporary, if it is for 2-3 months, that 2-3 months, your value would have dropped from what it was 3 months earlier. It would have dropped. At the same time, your purchases which have happened in these 3 months have gone at a very favorable price. You have an advantage of having bought at a cheaper price for 3 months. If it is a longer fall or a bigger, deeper one, then the impact of your existing investments, yes, it will be even worse compared to the first scenario. But the advantage of your purchases is even more. For more number of months, you buy for further cheaper price. Okay. So for somebody who is in an SIP investment, most investors are falls which are deeper. Okay. First of all, understand the longest of falls have lasted only for about 1.5 years plus, under 2 years, the longest of fall. And for what period is an equity fund suggested? Because most long-term investments are in equity-oriented funds. Equity funds are suggested for a 5-year plus period. In a 5-year plus period, even if your 1.5 years is bad, you will still be landing at about 12% kind of a return annualized. So this is what would happen even if there is an interim fall, big or small. Indicator-wise, today's order, there can be indicators, okay, but the indicators of the fall, whether it is long or short, will not be able to tell you about the longevity of the fall, right? So what I mean by that is, I feel at least in markets like India, you may have time corrections, right? Time corrections means, markets may not move anywhere, may not fall much, but will be stagnant or at most at the same level. That is the case almost in the last 14 months also. It's not fallen much, but it is almost there, stuck in that place. This is what can happen in a market where valuations are higher. Earnings are not so bad, but not so attractive. And there are relatively other economies or stock markets which are doing well globally. For these reasons, India might not be taken so seriously, and for these reasons, it will be stagnant. So, time correction. Why I said don't think these indications will give you the longevity of the fall. COVID has actually taught us, has surprised anyone. When COVID, in the fall, markets fell about close to 40% in a very short span of just 2-3 months. Most experts almost wrote the fate of that year 2020, saying this year markets will give zero returns or negative returns. But it surprised everybody, came back and gave positive return in that year, right? And even in my lifetime, I have not seen a disaster of that sort, a pandemic of that sort. And that is the case even for the last century. Okay. So even in your case, what you have seen, that is one of the worst fall, most unpredictable and most painful of sorts, which itself did not last for more than a couple of months. So what does this mean? Why markets lasted or market fall lasted even to 1.5-2 years period earlier is, those days the sentiments played a big role. Sentimentally, you lose hope, and it's very difficult, or it takes a longer time for him to recoup and come back with belief. No more markets, because they have evolved. The new generation looks at things very rationally, fundamentally. Sentiments may not shake the market for a very long period. Sentiments matter. Definitely not to the level it used to be earlier. So false, if at all that happens for 1.5 years, I'm saying even if it continues that earlier trends of 1.5 year of a fall, in a 3.5, in a 5-year period, you still have another 3.5 years, which will easily cover up and give you a double-digit return. So this is how a fall should be approached, market fall.
Hello, sir. So my question is that after my college degree, I'm planning to take a drop, and in that period of time, I'll be doing freelancing as a UI UX designer, and my income is irregular, but it's promising. So in my mind, this question arises whether I should focus more on stability or on growth.
You are saying your income also will be irregular.
Yeah.
Correct. If you are a freelancer, when the amount is not fixed every month, it may not be regular. But it is all right. SIP is not the only mode of investment. You can start with any amount, and as and when you have monies, even to the extent of 1,000 rupee, you can keep adding to the same investment. So in your case, if you become a freelancer, that's how you should be. And regardless of you or anybody who is in your age group, regardless of the mode of income, whether it is regular or irregular or staggered, idea should be growth. There is no second opinion on that. Why growth? Because you have age on your side. You have easily another 25 years left for you to come to your major goals. So major money consuming goals are house, then it is children's higher education, marriage. After that, it is retirement. And except house, okay, none of the goals come before 50. And house you will generally get at a very attractive rate of say 8.5%. It may be further lesser when you go forward. Housing loan anyhow is available at a low rate. So, but for 30%, 40% of your home house value, mostly the rest you may buy through a home loan. So, and you can't liquidate the entire money which you have and put it in a loan. Put it in a house. You should still have a surplus because you will have emergency situation. Just because you have own a house, it doesn't mean you will not have emergency situation. Because you have a house, if you put your entire money there and your housing loan EMI also will be sizable, which means you will have very little cushion for managing your unforeseen emergency situation. So you should have some surplus. And because you have age on your side, the number of years only keeps your money growing. Okay, I'll take a pause here. And why I say the number of years which you invest makes a big impact. I gave an example of 30 years, what would be the case. Now again, I take a case of an SIP. If you do an SIP for 10 years, okay, so 10,000 rupees, example. So 10 years you would have invested 12 lakh rupees. The chances are it would have become somewhere between 24 to 35 lakhs. Okay, so your invested money after 10 years. Your money invested is 12 lakhs. It has grown more than twice to 2.5x. The moment it goes to 15 years, okay, this becomes 4 to 6 times. 4 to 6 times. 4 if it is only around 12%, 6 if the return was around 15%. The moment you go to 20 years, in the case of a 15-year return, it becomes 10 times. Your money invested would be 24 lakhs. It would have grown to about 2.4. So the number of years makes a big impact in the growth of the money, and this can happen only if you have a growth kind of a portfolio, growth oriented portfolio. So mode of investment can be any, but the objective should be growth. With that, there cannot be any compromise.
Yes, sir. So I had a question. Recently, again, on social media platforms, there's this huge debate where rather than buying a house, rent a house and then buy it later. I genuinely believe it is not all that true. So can you please share your opinions on whether you should outright buy a house or rent one and then buy it later? Because, yeah.
See, in India, if you were to go only by financial sense, economically, does it make sense? Financially, does it make sense? In India, broadly, buying doesn't make sense. The reason is, so there is a thumb rule kind of thing to check this. If your annual rental yield, what do we mean by that is, the house in which you stay, if the value of that is 1 crore, okay, what is 4% of that? 4 lakhs. If your annual rent payable on that particular house is less than 4 lakh, then it financially doesn't make any sense to buy a house. Why? In India, the average rental yield across all the cities, it's only around 2.5%. Which means, if you buy a house and rent, or if you stay, the money is which you have invested on that is making only so much. It's only making 2.5% in a year. And except for the rosy years of real estate, which can be 2-3 years in a stretch of 10 years. So in a stretch of 20 years, it may be only 5-6 years. There will be at least 12 to 15 lull years in real estate. Real estate, always the good years are really bloated so much. They are exaggerated. But the good years are very few. If you average the good years and the lull years, the capital gains or the value appreciation annually is hardly around 7-8%. And this is 2.5%. So around 10%. What did we say as a return conservatively in an equity fund? 12% plus. Okay, you have nothing to do there. You don't have to go and find a tenant if you rent it out. Okay, and here after 10 years your house may become so outdated, amenities wise, facilities wise, interior wise, and you will have to spend heavily on that again. Rather, if you are on a rented house, you can keep changing as you wish. Okay, one, and your yield is low. And unfortunately, if you are caught only in the lull years of real estate, even this will not be the return. Okay, this is again only if you have bought it without a loan. The example which I gave is only if you have bought it without a loan. How many Indians buy a house without a housing loan? Very few. Then which means you are also paying an interest on your housing loan. So financially it makes no sense. Traditionally in India, okay, it's a sentimental asset, emotional asset. I need to keep my foot on the place which I own, not in somebody else's place. I can do whatever nonsense I want. Nobody will question me. And the place which I live should not be belonging to somebody else. It should belong to me. So this emotion or sentiment is what has put buying a house as a very top priority in anybody's life. But things are changing. We come across a lot of youngsters, like you, who are very clear that they will not even buy a house in their entire lifetime. Regardless of people at very high income, for that matter, even car. You take cities like Bangalore, people with very high income don't buy a car. They don't see any sense in taking so much time traveling by a car, almost double the time they would take through a metro. So the luxury of car, the sentiment and emotion of a house is almost out of the way for many youngsters today. Financially, it doesn't make a sense in India to buy it. And maybe real estate, a land bought at a very good price, in the outskirts after 20 years may appreciate. Okay, as an investment, some would. But again, you should give such a long time. But as a house, not necessary. And also because of the fact, the moment you get committed to a house of your lifestyle, it's highly possible that at any point of time, if you do a net worth a calculation of yours, 60 to 70% of your overall net worth will be in that house. And if this is the only house of yours, most people don't have a second house. They would own only one. And if you are a person who bought it for an emotion, sentiment, and which obviously means you will never want to sell it. If for this long, if you have lived in your own house, the next left, whatever years left, you will never want to be in a rented house. Which means, as a wealth, that's of zero value. You are never able to, you will never go and liquidate it. Only the non-real estate, non-house, except the house, whatever is available, only that can be called as your wealth. Because that is what is available at your disposal. This is not.
The rent that we pay and the EMI for the home loan, what if there's not much difference? Then it would be better to...
Then you are only as good as the first example I told you. If your rent has been taken care by the takes care of the EMI, then my first logic holds good. Rental deed is 2.5%. So you are not paying any interest. But what is the return you have made? And here also you have made an upfront. Minimum 20% has to go from your pocket. Minimum 20% has to go from your pocket. Balance 80%. Very, very rarely, if you have made 20%. Your example may be true if somebody has made 40-50% from his pocket, 40-50% of the value of the house. Only if you have paid 40-50% of the value of the house and taken 50% as home loan, this will be true. Which means 50% of that 1 crore has already gone from your pocket. That's yielding 2%, 2.5% or even more lesser than your otherwise equity investment. Correct? And had you not had this house, okay, the EMI which you are paying, though it is offset, if that was invested instead of this house, had it invested in equity, it would have given 3-4% more. Your original investment also would have given higher returns. Your monthly investment also would have given higher returns.
Sir, I asked for a personal basis. Like if I'm staying, if I have to pay rent, I would much rather, there's a scenario where I can use that payment as a home loan in my own house. So that instead of paying rent, I'm buying an asset, right? That's the logic I'm asking.
So, you see, I will phrase it in a different manner also. As I told you, EMI being equal to the rent is possible only if you have paid 50-60% of the value of the house upfront. Otherwise, it will never be the case. Next, if you have a 50 lakh of investment and don't have a house, 50 lakh, you didn't buy a house, you invested in equity, and the monthly EMI you don't have to pay, that also goes in an SIP. That also you continue. Almost in 5 to 6 years, this 50 lakhs will become 1 crore. You will be able to buy that house. And this EMI, I mean the 5 year of or 6 year of monthly SIP which you have done, all is excess. So use any logic, real estate will be easily defeated by equity.
So I had another question based on salaried as you start off in your career. How much of my income should I dedicate to investments apart from my living expenses?
See, if you ask me, if you are in the today's standard of a beginning salary, if you are living with your parents, at least 50% should go as savings and investment. You're living with your parents. So because your expenses are only your lifestyle expenses. You don't pay for rent, food, anything you're not paying. At least 50%, bare minimum. If it is not so, if you're somewhere outside also, nothing less than 30%. And I'm saying bare minimum. This can be another 10 to 20% more based on your lifestyle. If your lifestyle is relatively low lifestyle, this can be 10 to 20% more. And the advantage of this is, these are the years when you have very lesser commitment in life, financial commitments in life. And that is why you can proportionately invest a larger chunk than what you may be able to do later when you have low commitments. As I told you the previous example, the more you are able to do early, higher is the compounding effect. And your retirement, which would have otherwise been in 55, can happen even at 45 or 50. So you may have 5-10 years extra, which will be completely owned by you. What I mean by that is, the 45 years of work, be it business, be it work, you are at somebody's disposal. If you are a business, you are at a customer's disposal. If you are in a job, you are at your boss's as well as customer's disposal. But if you retire, that years belong completely to yours. The number of years you own will be decided more by the more investment which you do and for more number of years which you do.
So just to take a few numbers here, the average starting salary we'll assume here is 6 lakhs a year. So about 50,000. So you're advocating that we invest 15,000 a month in.
If you are not with your parents, if you are with your parents, take it. See, do you really need more than 25,000 rupees in a month? Your food, habitat, everything is along with your parents. What will you do with 25,000? If you want to buy an iPhone, right? 10,000 rupees monthly, 1 year you will complete it. Today, the maximum money which you will spend are probably on a two-wheeler. Maybe next is when you will graduate to a car. Even for a car, at that level, you may mostly not buy at 6 lakhs. You may go for a car when you are 9 lakhs, 10 lakhs. right? You take any calculation, it will be clearly justified that you should be able to do 50% in your initial 3, 4, 5 years.
Recently, when I watch videos on YouTube, the one ad that I frequently get is all these apps that provide bonds, and they claim to provide 12%, 11% returns and all, which is somewhat similar to the conservative mutual funds. This sounds too good to be true. What's your take on this?
No, it only sounds too good to be true. It will not. It is never good, and it is true but never good, right? The reason being, what is the rate at which you get rate you get on a fixed deposit today? Fixed to 7%. 7%. So a bank today will lend at 1-2% more, right? So for credible investors, for credible borrowers, right? Credible borrowers with individual or business, you will get it of approximately 2% more, which is what percentage? 9%. Keep it as 9%. Okay. It can go to 10%. So if this company, which is coming to you and saying, I'll give you 12%, 13%, why is it coming to you? The bank said no. If the bank had told yes, I would have borrowed at 9%, 10%. He told no. And he went to NBFCs. NBFCs also said no. Then the last option left is the public. You should know somebody who is rejected by a bank and other large dependable sources. After that only he comes to you. If it had a high credibility, then also he might have come to you, but he would have told you, in an FD you get 7%, I will give you 1 or 2% more, 8% or 9%. Mostly it is 8%. Normally the highly credible companies, which means the reputation of companies, if it is high, they generally don't tend to pay more than 1.5% more than an FD. They don't have to, because if they have to pay you more, then that more was available with the bank. When they go with the bank, the cost of servicing it is much lesser than borrowing it from you. So many investors, so much of operations involved, so much of manpower involved. The same you would have got at a much lesser price there. He is not getting there, that's why he is coming to you, which means he has rejected, which means the risk of the smart money coming back to you consistently is very high. If that was consistent and the visibility of that coming consistently back was high, the bank would have given, right? They see a risk. That's why they have not given it. That's why they are coming to you. It will be 12% looks nice, but luckily, if that company did not come across any problems, they may continue to pay. But there is always a probability that they can default.
So, but most of these apps, when they're advertising, they usually advertise as verified and regulated by SEBI, and they usually have the right words that all regulated financial instruments have. And also, the bonds they're issuing are not random ones. They're usually large financial companies, large NBFCs that are renowned to the public and have been successful. And they're still offering 12%, which now seems like a good offer given the history of these companies.
What you are saying is right. Some names would be familiar. How familiar names defaulted in the past? Familiar names also. DHFL is a very big company. Defaulted. They could not pay back. Okay. So there have been many instances in the past. Familiar doesn't make it very credible. And see, SEBI doesn't say no. SEBI doesn't say to a company, you can't borrow 12%. The SEBI will never say you can't come out with a bond which can give 12%, 13%. SEBI's job is not that. SEBI's job is also to monitor the credit rating. They will all have a credit rating. It may be triple B, double A minus, single A. The credit rating agencies are monitored. So which means the credit rating agencies will ensure that they don't give a, it's like this, you go, somebody, is getting married. A dependable source says this fellow is a good fellow. Then you have that belief. Here, that dependable fellow is saying, this fellow is not so great a fellow, credit rating. If you still want to marry, he marry. SEBI does that. SEBI doesn't say you don't want to, you cannot come with it. SEBI can only do this much. It is ensuring your safety by giving a credit rating which matches that profile, which will be much lower in terms of company like that. So now whether you want to get married or not is your call. So it's like that, So because see, let me also say this. Sometimes it may not mean the company is bad intended or bad. Sometimes what happens, a company which is young, for you to get a higher credit rating, You have to have that mature. You have to evolve. Only then your reputation is built. Somebody is good, but he cannot wait long. He is in urgent need of money. He's good. Sometimes you can take that call. Very rarely that might be an instances. Why I say very rarely? Today, if there is a company which is young, like this, very good management, very good business, very good visibility of the cash flow, there are, if not a bank, there can be a fund. So alternate investment funds which lend to companies in the form of debt. They are available. So which means if this was that good, probably they would have found a space there. After all this, if it is coming here, probably you should be really lucky somebody missed it.
So, sir, people of my age, mostly the young ones, what we can have or attain is confidence, and what we lack is experience. So, tell me, sir, how can we judge the financial risks, and how can we say whether it is worthy to take it or not?
Okay. See, for somebody at your age, today with so many forms of mutual funds are available, which brings you great portfolios to you, you probably should not venture too much into a stock, direct stock at this moment. Maybe that is something which should come slightly at a later stage. After you have, see today, whatever you may see at this young age will be all downloaded information. Nothing is experienced information. It's all downloaded. Downloaded information sometimes, the same Google may give a positive and negative review about the same thing. Because there are so many people writing about that company. Somebody writes good, somebody writes something bad. So how will you really filter? Not possible always. So until you get an experience of equity investing for some years at least through mutual funds, don't go directly into stocks. Okay. If at all you want to get into stocks, so look at the credibility of the management, the business model. Okay, the business model, whether it is sustainable, whether this can be disrupted very quickly, that the business will be nowhere, right? And who all have funded this? Okay, what's the employee strength? Do they overspend? And how is the cash flow? And what is the earnings visibility of this company? So these are things, and the value, the PE of that company, whether it is trading at a very high value compared to the peers. These are the information which you should check. And as I told you, this should be secondary, because today such good companies are part of some mutual fund portfolios. Find mutual fund portfolios which have that kind of basket of companies, because here, had you even, see, you probably did a good choice of a good company. Not all great companies will reward so much in the stock. Very often you may see a company doing well, but the stock will move nowhere. And it will be very difficult for you to take a call, because you still believe the company is good and it is good, but probably that's not replicated in the stock. It very often happens. This call, an informed, experienced fund manager will be able to take call. Yes, he would also have made such judgments, which would have failed, but he would take a call at the right time, which you will not be able to take. Because what happens when individuals invest in a stock? Egos come into play. Self-ego. Even it is ego sometimes. Sometimes it's a lighter version of that. It's not necessarily that I'm rigid, but I still have the belief. Both are two different things. So I may not book losses. That's also another problem. Most people don't want to sell their investment at a loss. Then you may prolong your losses, or you prolong your holding time. Taking a call becomes very difficult. So this all needs a lot of maturity. That's why first test the waters through this. Then you evolve into that next phase. Until such phase, and probably if you still want to take a risk, do 10% of your investment through that. And there again, be very clear. You should not be emotionally attached in any investment for that matter. No emotional attachment. Think sensibly. If insensibly it is not moving, for some reason the company goods is good, continues good, but investors are not rewarding it, the price is not moving, you have to come out at some point of time. How long can you burn time? Because time is everything in investment.
Yes, thank you so much, sir, for all your insights. So, as most of our questions are from social media only, and now we do understand, rather than just going through social media as alone, we should have our own brain and think about things and not fall for the hype. And you really addressed a lot of concerns of ours, of our friends, of our family members. We all had the same concerns. So thank you so much for it.
Thank you. Pleasure. So invest wisely and hope to see you as great investors. Nice. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.